Good afternoon from Milan and welcome to this Invest in Lombardy webinar on doing business and investments in Italy. Let me first introduce on my left Mr. Ettore De Pace.
Good afternoon.
Mr. Colin Jamieson.
Afternoon.
Of the firm Belluzzo and Partners, partner of Invest in Lombardy, that will soon go through all the details about taxations in Italy, especially with the focus on foreign companies doing business and investments in Italy. I briefly provide you with an introduction on Lombardy region, the leading region in Italy in terms of business and investments. So first of all, why Lombardy? Lombardy, if it was a country, it will be the 6th country in Europe. Some of the figures you see in the slides show you the important amount of activities and businesses in Lombardy region. Just a couple of them. So 25% of the Italian GDP comes from Lombardy. Lombardy has more than 800,000 companies in several sectors, and more related to our topic of today's webinar, 92 out of 100 leading multinational companies have their own headquarters in Milan. So this, in order for you to understand the important and the strategic role of Lombardy and Milan in particular, but Lombardy region more in general in terms of the business and investment environment in Italy. When we talk about Italy, business and investment environment, we definitely have to look at Milan as the gateway of investment. So the first point, the point of reference for multinational companies that want to enter the market. In terms of opportunity for companies, for foreign companies to start their own business in Italy, Milan shows impressive numbers in terms of days, so timing for procedures in both registering and starting a business on the field. So this is important for foreign companies to understand. Here is easier than in other cities and regions, not only in Italy but in Europe, to start your business. Some point we always want to point out is related to the combination, so that the so-called matrix of quality and cost. Milan is, in general, Lombardy region is one of the leading regions compared to other important centers of business in Europe in terms of quality of the manufacturer, quality of the employees, and cost of the activity. This is the source is the annual FDI benchmark provided by Financial Times, and this is something that always help us in our activity of promoting the attractiveness of the territory and of the doing business in Lombardy region. In particular, what we see today from our point of view of the Invest in Lombardy Observatory is that there is an increasing numbers of small and medium companies that are looking for investment, so are capital seeking, and figures, results of the last few years show that Lombardy, both in terms of turnover and gross margin, allow foreign companies to make very important, very relevant margin compared to the European average. So that's why if from one side we have an increasing interest of small and medium companies to look for foreign companies to enter in the market and to enter in their capital, at the same time we, especially in our activity of promoting and scouting of companies abroad, we see an increasing number of companies, of foreign companies, that look see Italy as a destination not only for greenfield investment, also in terms of M&A opportunities. This is another example showing Lombardy as a relevant, I would say an outstanding destination that provide at the same time high level of manufacturing. So the example you see in the slide shows how in the manufacturing sector Lombardy is the leading region in Europe in terms of high-skilled employees, having at the same time average costs for the companies. You see the slide shows that considering OECD data, both in terms of hourly wage and in terms of labor cost, Lombardy has, this is an example related to Italy. Of course, Lombardy is part of it. Italy has lower cost than other European countries like France, Germany, Austria, and UK. Another important point of reference of Lombardy is definitely the position. When I mentioned the fact for Lombardy to be a gateway of investments, this is also related to the strategic position of all the Lombardy region in terms of logistics. The slide shows how Milan has very high numbers of companies in warehousing and storage. As for our point of view of Invest in Lombardy Observatory, we can say that there are a lot of companies in the logistics sector that are looking at Lombardy as a suitable destination of their activity, of new offices to be opened soon, with also competitive advantages in terms of cost. As you see, those data of 2014 of World Capital shows that Milan and Rome, so it's not just a Lombardy point of advantage, but it's also an Italian point of advantage in terms of real estate in logistics sector. Costs are among the lowest in compared to other European and international cities. A few final information from my side. A good thing to know for foreign investors, potential investors, to know about Lombardy is that the region is very much differentiated in terms of sectors. You do not have to think about only the more traditional sector like fashion, like food, like manufacturing in mechanical sectors, for example, but you have to think about very high level of innovation sectors, like it's the case of life science, of engineering, of ICT, of financial services, which definitely make Lombardy a very attractive potential destination of your business, having a lot of connections among different sectors with no, I would say, exceptions. Final word related to our project. So together with a network of public institutions, so Lombardy region and Lombardy Chambers of Commerce above all, but also with a strength, an increasing, I would say, network of private partners. So Belluzzo and Partners is one of those law firms leading the network of our partners. We are able to provide potential investors or companies that want to do business and think about an investment on the field. We provide fast answers and a very stable support from the very first beginning through all the phases of the potential process of investment. Our results of the last 3 years, the numbers you see in the slide are related to the last 3 years of activities, with more than 8,000 meetings with foreign companies, more than 500 foreign investors that have been assisted, that have been supported, and an interesting return on investment for the public investment on this project. So for every euro invested by the public sector, 112 euros of investment have been finally conceived on the territory. So this definitely makes us quite proud of the activity that we would like to even more foster in the upcoming years. So now that's all from my side. I thank you once again, Belluzzo and Partners, for being here today. And I leave them the floor in order to go through more specific information about taxation incentives for companies that want to do business and investment in Italy. Thank you.
Thank you very much. Thank you very much to Invest in Lombardy for the opportunity to do this presentation. I've been working in Italy for 25 years, more or less. The tax background has changed immensely from a form over substance-based regime with steep penalties and a very rigid system when I arrived. The Italian government has worked a great deal on modernising and making the tax system more attractive to foreign investors, making it easier to operate here. There's parts of the Italian Tax Authority's website now in English. You can download forms, tax credit forms in English, for example, and French, I think, and German, of course, because both of those are languages spoken in parts of Italy. So it's a very different scenario that faces the foreign investor now than when compared to when I started, and some of that is modernisation that's been taking place in other countries. But tax returns now are entirely online. Tax payments pretty well almost all online via the bank. And the penalty regime, which 25 years ago was extremely steep and unwielding, has been the subject of a lot of reform and recent retouch in last year's Finance Act. So the message is more transparency from the taxpayer, less of a heavy hand from the tax authorities, more dialogue and playing fair. And I think Italy, in the old days, had a bit of a bad reputation for the tax regime. And I think it's fair to say now that criticism is pretty well unjustified. There's obviously always room for improvement, and I think that applies to all modern states. The European Union is working as hard as it can to try and harmonise the rules and make it easier to work across border. And the Italian governments over the years have certainly been a large supporter of that initiative. So let's get down to brass tacks and look at these are the main types of business structure that foreign investors are going to be using to come into Italy. There are others, of course, but the main choice is basically between a limited liability company or a branch of the foreign company. And I'll come back to them in a minute. The third entity there, if you like, is simply opening up a representative office, which means a simple registration with the business registry, but no tax presence. And that's good for companies that are carrying out what the OECD Model Treaty calls preparatory and auxiliary activities. So companies that are coming into Italy, doing market research, collection of data, simply presenting their business without carrying out any activity of sales. So that's a very light, easy structure, easy to get registered, easy to set up an office. But typically you won't have a VAT registration, and you may not be able to get all of your VAT back paid in Italy. Some of it you will get back through the direct refund procedures. And the point there is that the representative office should only be used for non-commercial activities. As soon as you start selling, as soon as you start having a sales team in country who are taking orders, accepting orders, then you've got to come and look at either one or two. the company or the branch. Tax-wise, there's not a lot of difference between them. I think one of the things, particularly for us Brits, the first time we come to Italy, we find that the accounting regime here is actually a tax compliance regime. So there are quite detailed rules in the legislation about how you have to keep your accounting records, which I think us from an Anglo-Saxon background, we don't have that. Our tax compliance is all year-end, maintaining orderly accounts, but not being required to keep, as in Italy, a day journal, a libro giornale, with a chronological list of operations. Now that can seem a bit of a shock at first, but Italy is full of accountants that can easily and cheaply help with that. It means that multinational groups with their own accounting system either need to purchase the Italian module so as to allow that accounting system to be compliant with Italian rules, particularly VAT accounting, and the other compliance requirements, or they need to have assistance. It does come as a shock, as I say, for the Anglo-Saxons. For other civil code countries, it's entirely in line. But the point is that those requirements apply both to a company and a branch. So it's not really the case to say, well, setting up a branch is cheaper or easier. They're pretty well the same. The Italian government has worked very hard on, as we've just seen from the statistics, on making it easier to do these registrations. And again, I can attest to that over the last 25 years, that it is immensely easier. The forms are all standardized, reduced numbers of forms to actually get started. And there's a very efficient business registry, which also provides a great deal of information on competitor businesses and other companies operating in the sector, as well as yourselves when you set up. So the choice of legal entity, probably not really tax driven, maybe an exception. If you've got a business with high infrastructure, high cost investment, you want to be able to get a tax deduction for the costs incurred in Italy against income directly in your home country. Well, in that case, the branch is probably going to be better for you, because the branch is consolidated, and under OECD principles, the branch will be a permanent establishment and therefore will be liable to register for VAT, really as if it was a separate person. Transactions between branch and head office are typically outside the scope of VAT, but for all the purposes, a branch will be a separate person for tax purposes. And then when we come to look at transfer pricing rules, thin cap rules, they will apply to the branch in exactly the same way as they apply to a company. The costs of setup are pretty similar. They're slightly different. The cost of maintenance, maybe a branch is a little bit cheaper because you don't have to produce annual accounts under Italian GAAP. You need to produce pro forma accounts, obviously, for tax purposes, but you don't need to file branch accounts with the business registry here, but you do need to file a copy of the parent company accounts. And if your parent company accounts are bulky, that might be quite an expensive translation bill. But apart from that, whereas a company, you have obviously to have an annual general meeting and the compliance there. The difference, SPA, very quickly, SPA is a public company suitable if you want to get a listing on a stock exchange. It doesn't need to be Italian. There's plenty of SPAs listed on foreign stock exchanges. And the SRL is a limited liability company, more suitable to be used as a subsidiary in a group. And the compliance requirements of an SRL are much reduced Probably no need to appoint a board of statutory auditors until you're reaching certain turnover and asset thresholds, or you've got subsidiaries and have to prepare consolidated accounts. So limited audit requirement. All companies here need to produce accounts and file those accounts. But at the moment there's a de minimis exemption for audit. Okay, so let's go on to the quick overview of the tax system. So once you've got your branch, your company, you're going to be liable to these taxes. IRES, corporate income tax, at the moment it's 27.5%. The Italian government have recently announced legislation stating that the tax rate, the corporate income tax rate, will be reduced to 24% in stages, and they are waiting on the go-ahead from the EU to next year's Finance Act to have the okay to proceed with that, and we'll know the timing. But the Renzi administration very keen on reducing the tax burden and bringing it into line as much as possible, actually bettering a lot of other EU member states. I have to say the corollary of that is an increase in the tax base. Over the years we've seen a limitation on some of the deductions of costs, but again that's absolutely in line with what all other member states are doing, having a reduced headline rate of tax and in a way trying to make the rules simpler and easier to understand in terms of the adjustments that you're making to your accounts to get to your corporate income tax base. But I have to say that I think Italy has a pretty generous regime on entertainment expenditure, for example, looking at other member states, and there are a number of other areas where certainly you can't say that Italy has an unfair or a prejudicial regime of computation of the taxable base compared to other countries. Now, corporate income tax base is worldwide. So you've got a resident company, then you're liable in worldwide tax. There is an exemption for branches, which I'll come back to in a minute. There's Italy is a fan of withholding taxes. It's got quite a developed withholding tax regime. And again, foreign investors need to be aware that payment to suppliers, payment out of interest, royalties to other corporations outside Italy in the group will probably be liable to a withholding tax. Now, as I say, Italy is a keen supporter of EU initiatives and has implemented fully the dividends directive and the interest and royalties directive. So typically there's a 0% withholding tax on payments of these items going out to taxpayers and other members in other member states. And even you can see the 1.375% tax on dividends is what generally applies outside the EU, with the 26% only applicable when you're paying dividends to a tax haven regime, i.e. a country with a low tax rate. And at the moment, those are contained on a list of countries. Apart from your corporate income tax, Italy also has a regional production tax, which was introduced at the end of the 1990s, and it replaced a social security tax. It replaced an employer's social security tax, and it was part of a more general reform with the idea that the funds raised as a regional tax would go to the Italian regions and are used to enable the regions to provide their services, and the main service in financial terms anyway is healthcare. So the IRAP is very much very much a healthcare destined tax. It's not payable on the same taxable base as IRES. The taxable base is it doesn't allow the deduction of most financial charges, so interest payable, the interest element in leasing costs, and controversially, it hasn't traditionally allowed a deduction for labour costs, with the result that the tax is often in the home country for foreign investors who are consolidating results of Italy. The tax is not deemed to be a real income tax at all, and therefore is not necessarily creditable against income taxes abroad. Most European states will allow it, will allow credit for it. UK authorities at the time specifically stated they considered it an income tax. 3.9% rate, so on this larger taxable base. Now, I said controversially because obviously if you're not allowing a deduction for labour costs, it's seen as a tax on jobs. And as I say, it replaced an employer's social security contribution. And governments over the years have successfully chipped away at that principle. So now there is a measure of labour costs that are deductible, and in particular labour costs for apprentices and new starters, new hires. And I think we're going to see more of that tendency with IRAP gradually being aligned with corporate income tax, and this sort of anti-jobs idea being phased out is something the government is certainly aware of. As you may know, the Renzi government has just implemented an enormous radical reform of the labour market, and obviously the labour tax system is an important part of that reform and modernisation. VAT 22%, with reduced rates of 4%, 10%. They don't have a zero rate as such, but transactions obviously like exports are not subject to VAT without affecting your input VAT. VAT rules are EU rules. Not a lot of differences. Italy has introduced a number of anti-avoidance rules, which means that if you're in sectors that are or have traditionally been liable to abuse, carousel fraud, that kind of thing, you need to pay attention to those. The construction sector, the building sector is another sector where there's specific anti-avoidance rules. There's a domestic reverse charge, for example, in the construction industry. So if you're in those specific industries, you will need to get advice because the rules are slightly different in other member states, obviously without prejudice to the overall VAT principles. And then that's it for the big taxes. Italy then has a number of other minor taxes, transfers of real estate. There's a transfer tax between 2% and 9% for real estate. The 2% is a reduced rate for principal residents. The rates seem quite high, but often, or generally, the taxable base is the land registry value, the cadastral value, and that value is typically a lot lower than market value all around Italy. So it might seem a high rate, but the actual base is lower. Local property taxes going to municipalities, and there's a number of small franchise taxes. So there's a tax on your statutory books that you need to pay. There's obviously fees for the business registry and that kind of thing. And stamp duty is exactly what it says. It's a stamp, and you pay that on notarial documents. I should have said there's a 3% transfer tax on transfers of businesses, and that 3% applies on the market value. If you are buying a business in Italy, you need to take care with the valuation, because the authorities will expect you to pay the full amount. Even if you're buying off a third party, the authorities have power to assess the market value of the transfer and assess that 3% tax on any goodwill that is included. Okay. So a quick look at reliefs and incentives in Italy. I think, as I say, over the last 25 years, the trend has been to reduce the tax rate and reduce the reliefs and incentives. That's also in line with EU regulations, which stop member states giving financial assistance through the tax system. So a lot of the tax reliefs have actually gone and are replaced by grants. And if you're setting up in business in Italy for the first time, you'd be well advised to talk to a professional about the grants that are available. There's a lot going on, and it's a specialist area outside of this, but the reliefs and incentives are not really being given through the tax system. One exception to that is the ACE, which is a specific deduction from tax based to encourage investors to leave profits inside the company, and you get a tax deduction for the notional yield on the increase in shareholders' reserves in net equity, in order to stop people, or to encourage people to keep money in the business, keep that money reinvested. Fourth line down, I've got the patent box, which is an idea that the Renzi government, I think it's fair to say, have copied from, I think, from the French. But it gives you, it's a long-term exemption for income from the exploitation or use of intellectual property. You can see there's a 30% exemption for 2015, going up to 50% in 2017. So taking a chunk of your taxable profit, taxable income out of the charge to tax, obviously to encourage the inventors, the designers, everything that's made Milan successful, stay here and not take up, not move abroad simply to get a tax advantage. Now that's new legislation. There's still some debate, I think, with the European Union on the exact extent of that, and in particular how far the definition of intellectual property and whether it will cover designs and some of the activities in the fashion industry. But the Italian government is certainly very keen on pushing this notion of a relief for intellectual property forward. They're also very keen on research and development. This has been a relief over the last, I can't remember, 6-7 years, maybe even 10, just giving you a tax deduction for costs of R&D. And then the other two items there are going back to what I was saying at the beginning, the possibility now that, which didn't exist in 1992 when I arrived, of requesting rulings from the Italian authorities, requesting formal guidance, which will be respected, providing the circumstances don't change radically, or provided you haven't misrepresented at the outset. But you can now go to the Italian tax authorities with a formal request for guidance. Transfer pricing, we'll talk a little bit about that in a minute. And there's a procedure where for any point of doubt you can go and ask for guidance and possibly a ruling. And that is a response to one of the criticisms that applied in the 90s, and I was there in the forefront of it, that the Italian tax system was very uncertain and vague and liable to change. They've definitely taken that on board as a criticism, and these ruling requests are the part of the response to that. So the other part of the response is setting tax rates in advance and allowing investors to see that tax rates are not going to be increased at will. Now, obviously, that depends on the ongoing economic climate. Some of the increases we've had, the VAT rate going from 20% to 22% was a response to the financial crisis. We had personal income tax, investment income tax going to 26%. But looking at the statistics, the recent statistics, which are very positive, and it is fair to say the Italian government are very keen on stating what the rates are now and for the future. Okay, so taxation of international groups coming into Italy. The concept of residence is in line with OECD principles. Concept of permanent establishment, the Italian government introduced a definition of permanent establishment in 10 years ago.
Yeah, right.
And there wasn't one before, so that was vague. We now have a definition of permanent establishment. It was exactly in line with the OECD standard treaty, and often a double tax treaty, if it's more favourable, will override that definition. But on the whole, the definition is entirely in line with international principles. The authorities are attentive to foreign businesses operating a permanent establishment. The penalties for having a permanent establishment but having failed to register it are very steep, and it's often a question of VAT, because once you have a permanent establishment, then you have to be charging VAT on your invoices, and of course failure to charge VAT falls into a potentially criminal sphere, and I definitely advise anyone doing business in Italy to think very carefully about whether they've got a permanent establishment, get properly advised on it if there's any issue, and get regularised. It's not difficult, and VAT should never be a cost for an ordinary taxable business. But it will be a cost, or at least the penalties will be a cost, if you have an assessment to VAT at a later stage for having failed to identify a permanent establishment. Those are the directives I was talking about before. Italy's implemented them, and I think on the merger directive, the third one, that's allowing cross-border mergers, Italy is well ahead. Italy's also introduced a very clear exit tax regime. So if an Italian resident company is moving its business abroad, there's now a very clear regime for either creating a charge to tax when that exit takes place, or the possibility of postponing it. And that makes Italy a very clear, gives you a very clear exit strategy if things don't go as well. There's a very clear tax regime, which there wasn't up until two or 3 years ago. So looking at some specific aspects of taxation of Italian companies, there's a participation exemption for dividends from subsidiaries, 95%. Italy's a great fan of taxing 5%, as you see also on capital gains, a 95% exemption. Capital gains, obviously specific conditions. You're not going to get the exemption if you're dealing with dividends from tax havens, or moving profit out of Italy artificially, or trying to repatriate low-cost, low tax profits. So, as I said before, there's a 0% withholding tax on dividends on the way out, a small 1.35% tax as a result of the dividend or capital gains exemption. I should say there's also obviously holding period conditions very much in line with the EU principles for getting the dividend exemption on the way out. So Italy's actually tax-wise not a bad place to have a holding company. And because of the extensive treaty network, which is the previous slide, particularly some very favourable treaties with Latin America, Italy...
Brazil, for example. Yeah.
Brazil, yeah, with tax sparing and
yeah,
which we can perhaps talk about in another occasion. But Italy as a springboard to Latin America is a very worthwhile jurisdiction. Italy has tax consolidation, tax unit, easy to make exemption, consolidated tax filing, consolidated tax payment, offset of losses around the group. And that also extends to Italian groups with subsidiaries around the world. So if they've got loss makers around the world, you can, in certain circumstances, benefit from those losses back here in Italy. We now have a fairly intricate, fair to say, but I think that's in line with most modern OECD states, intricate CFC regime. But again, it's a pretty clear regime. And again, there's a ruling procedure so that if you're potentially caught under CFC rules having to attribute profits from an overseas tax haven, what is considered an overseas tax haven or a low tax jurisdiction, because the CFC rules apply to any jurisdiction where there's a less than the tax rate is less than 50% of the Italian rate. There's a procedure to say, no, I had bona fide reasons for going to that tax haven. It wasn't, I wasn't going there just to shuffle my profit offshore and not pay Italian tax. And you can get an advance ruling on that. I left out, there's an exemption for branches, 100% exemption for an Italian company with a foreign branch. Again, that's a response of the government to similar regimes. I know the UK has implemented a similar regime. So foreign branches, obviously, condition for that is the foreign branch is paying tax properly at a reasonable rate. Abroad, you can't use these rules to push profit into an offshore low tax jurisdiction. Italy does have some rules denying a tax deduction for costs paid to those listed tax havens. If you're investing, if you have an Italian company that's purchasing, particularly from the Far East, some regimes there, Hong Kong, for example, is considered to be on that list, and costs won't be deductible unless you can show that there's a bona fide commercial purpose.
Anyways, regarding Hong Kong, we have to say that just in the last August, Hong Kong is no more. There is a new treaty, Italia-Hong Kong, so we hope that in the next future there will be out over this blacklist.
Yeah. And Singapore has already come off. Singapore came off.
Now no more blacklist to Singapore, for example.
Again, another example of my process of modernisation and being able to tackle properly tax avoidance, tax evasion, tax abuse, while allowing bona fide groups to carry on business normally, and that's a welcome change. Italy has transfer pricing rules very much in line with OECD guidelines. So transactions between companies belonging to the same group, cross-border, need to be justified, and obviously the larger the group, the more justification you'll need to do. Italy's implemented the master file, country file system that the OECD have recommended. And if you've got significant operations between another group company in Italy, you will definitely need to get specific advice and probably work with your advisors, your tax department abroad to ensure that the Italian rules are met. And the tools, the benchmarking is now, compared to 20 years ago, now a very easy procedure. There's proper databases, and there's really no excuse for large groups not to have proper transfer pricing documentation in place. Okay, well, that is it
we have
today.
some questions.
We've got some questions, okay, good.
So we can start from this question, if you only want to read from number 1 here.
This one here.
Yeah.
Any deadline for patent box applications? I think the deadline's end of this year.
Right, because this is a news, no, for Italian regime, this patent box, and so to apply this new regime for the fiscal year 2015, there is to make an application by this December 2015 for the following this year and for 2016. So there is a deadline in December for this year.
We can go through this.
Okay, any relief against tax for purchased goodwill? Well, if you're purchasing a business as a going concern, then you will get tax relief for that goodwill. And I think it's 18 years. Somebody might want to correct me, but the amortized, it's obviously capitalized and amortized. When I arrived in '92, we were all, when you're buying shares of a company, you don't get any relief for the goodwill. The technique when I arrived in '92 was to set up an Italian holding company and effect a merger. And that merger, you would crystallise the goodwill, which would be the difference in the purchase price in the holding company's books and the net asset value of the target company. Those rules, they've put a stop to being able to do that, and the only way you can get tax recognition or a step up in inside basis on the purchase of an Italian company through the merger route is to pay a substitute tax. And there's been a series over the years of options at various rates, 2%, 4%, depending a bit on also what the assets are, to be able to step up, and not just on a merger, but to be able, for taxpayers to be able to step up the assets, maybe align tax values, tax written down values to book values, paying this small substitute tax. Now with the, if you're looking at a 15, 20, maybe a 30-year amortization period for real estate, then typically the cash flow advantage is not there. You pay tax today and you get your benefit back over time. So I think the short answer to that is no. Not without going through a lot of hoops. Next question, is there a de minimis limit for compliance with transfer pricing regulations?
Right. In Italy was introduced a specific documentation regime for transfer pricing, and this is to be in compliance with this regulation. It is not mandatory, but we strongly suggest to produce this documentation, because in case of tax assessment, it is crucial to prove to the tax inspector the matter, the documentation, how the value of intercompany transaction has been conduced. So we suggest anyway to produce this documentation in accordance with the OECD guidelines that we have.
I think that probably comes from the UK, for example. I know has a small and medium-sized companies are not required to produce full transfer pricing documentation. That small and medium-sized, I think, is in line with the EU. So there isn't any similar de minimis limit here. But obviously, if you're a small startup, then you may be purchasing goods from head office and selling them in Italy, then you need to let the business make sufficient profit to make it worthwhile to carry out the transfer pricing documentation. But having said that, I would always advise right from the beginning to have some form of note, internal memorandum, board meeting, whatever it is, stating the rationale behind the transfer pricing policy that's being adopted. Why is the Italian company being given a margin of 30%, 40%, whatever it might be? Okay, next one. Any limitations on the nationality of residents of Italian company directors? No, there aren't. There's no rules. Anyone can be a director of an Italian company, unless you've obviously had criminal convictions or prohibited from acting as a director, regardless of nationality. I think the only exception to that is that Italy does have has a principle of reciprocity, so that if Italian citizens are not allowed to purchase property or become company directors in a particular country abroad, then a similar restriction applies, and the Ministero degli Esteri hold a list of what those are. But certainly for EU member states, there's absolutely no restriction, and you don't need to be resident. Now, obviously, if the boards are not resident in Italy, and the board are the ones who are taking the strategic decisions and are the de facto place of administration, the company may not be resident in Italy, it might be resident somewhere else, but that's a problem for somewhere else. So it's just the tax rules apply on the basis of residence. The definition of residence in Italy is the principal place of the administration, the management of the company.
Right. To avoid the risk of to be permanent establishment in Italy with foreign company.
Yeah. Okay.
There's another question more specifically related to the point of view of investing in Lombardy. So if there is any incentive or relief in Lombardy expected for the upcoming years over the next few years, what I can say from our point of view is that definitely Lombardy region is trying to push harder in implementing a new form of, I would say, soft incentives, because as we have seen, the majority of the taxation comes from the national side, but definitely Lombardy region will confirm for the next year as well the so-called competitive commitment, so accordi di competitività, giving both Italian and foreign companies the opportunity, especially if the activity that will open, so the investment that they will do, is related to research and development and some innovation activities, especially if it's related to some environment topics, we will allow companies to benefit from some reduction by giving grants to those companies. So this is definitely something that has been very well considered especially by foreign companies, and we are sure that by this new commitment that will soon take place in 2016, this will be a way to facilitate, so somehow to attract foreign companies. Definitely there are also other kind of incentives related to, and Lombardy region is one of the more, I would say, proactive regions in Italy to use the European funds. So definitely all the new program from 2014 to 2020 will provide companies working and doing business and investment in Lombardy region the opportunity to access to these funds, to this both direct and indirect fund. There are some Italian incentives. I just want to mention some related to the so-called legge Sabatini related to the machineries. So of course there is a combination of incentives that cannot themselves represent an opportunity, but together with all those things we have mentioned. So the different sectors, the possibility to mix services and a great manufacturing will make at least Lombardy, but I would say also other regions in Italy, an ultimate destination of investment. Very last word, as Mr. Jamieson mentioned before. So of course, those taxes levied by municipalities are just a small part of the taxation, but through our connection and through the Observatory Invest in Lombardy, we have seen recently how more and more municipalities at the territorial level are aware of the importance of making investment on their territories. So some of them are already considering to make some zero tax program on their territories, also by providing territories either for free or with incentives in the cost for foreign companies that want to settle their factory, their offices over there. So I would say that a combination of procedures and of new strategies, both from the national side, as colleagues mentioned, the government, as it's very keen on boosting investments, the combination of the national and the regional and municipalities levels will definitely make Italy, not just Lombardy, a more attractive destination of business and investment. I hope that we were able to provide useful information. Thanks once again to Belluzzo and Partners,
Thank you to you,
Colin Jamieson, and Ettore De Pace for being here today with us. And for all the Invest in Lombardy webinars, all the registration will be available soon online on our channels. So both on YouTube, Invest in Lombardy channel, and on other promotional channels that will allow participants and all the other people interested to go through all the contents we have discussed today. So thank you once again, and see you at the next Invest in Lombardy webinar.
Goodbye.
Thank you.
Good afternoon.